Meantime, the big story of the day is what's happening on the jobs front in this country. Joining us with analysis in today's somewhat disappointing jobs number and to talk about what the new natural unemployment rate should be is economic forecasting expert Ethan Harris. He's head of developed economics research at Bank of America-Merrill, Lynch. Ethan, thanks for joining us today. The knee-jerk reaction is that this number is disappointing. Bill Gross said the number was anemic. How do you characterize it?
Well, I think given the fragility of the stock market, it's not surprising that people got pretty excited in a negative way about this number because, you know, this is another one of these little signals that the market's looking for of concern out there. If you step back, very disappointing headline. You can't sugarcoat this too much because private payrolls is the most important monthly indicator. But the rest of the report was fine. I mean, you had pretty good wage growth. You had an increase in hours worked. Incomes for the month actually rose about 0.6%, wage and salary incomes, or 7% at an annual rate. So again, you can't really dismiss that the bad private payroll number, but there's some silver linings in there.
So, I mean, do you think that this indicates to you that the recovery has lost some momentum?
Well, I think it does call into question how strong things were looking at the start of the year. I mean, we came into the new year with a lot of momentum in the data. Private payrolls had been accelerating steadily every month for many months now. And this puts a kind of a dent in that story. I don't think it's a sign of a double dip. I mean, for example, it's much too early for payroll jobs to be reflecting the stock market turmoil. It takes a while before companies react to stock markets, and the payroll survey is taken in the middle of May. So I don't think this is a sign that companies looked at the stock market and said, oh, I don't want to hire. I think it's more a sign of, maybe that underlying trend that we thought was accelerating actually isn't, and we're in an okay recovery, but it's not a great recovery.
The market seems to have replaced Greece with Hungary today. New concerns about their level of debt and whether they're going to be able to essentially pay their bills. What do you make of this? Is this just fear, or does this change your outlook?
Well, fear can create reality. And one of the things that's happened in the last month is accumulation of negative stories. It's Greece. It started in Greece, but now we've got concerns about China's slowdown and the Korean tensions. And, of course, anything that involves sovereign debt like Hungary gets a lot of attention. So the markets are very sensitized to this news. I don't think this is the beginning of a big global slowdown or anything. I think we'll work our way through this period. But it's concerning when the markets kind of are weak for this long a period of time.
Have you looked at all here in the United States at the question of what the Gulf spill in the Gulf will have, on the local economy as a spillover? I know Robert Shiller said from a behavioral economics point of view, he thinks that there is some reason for concern.
Well, I think that you have to separate out the human and environmental disaster from the impact on the macro statistics. So this is a horrible disaster, but from an economic point of view, the job losses are probably going to be modest by national standards.
All right, Ethan Harris, thanks for giving us your analysis today on this jobs figure.